In times of economic uncertainty, when things get tough financially, there are golden chances waiting for those who can adapt and come up with new ideas. Economic downturns, like recessions, can be really tough. They can make lots of people worried, cause them to lose their jobs, and make money problems even worse. But here's the surprising part. Recessions can also be like a secret treasure chest for people who are smart and can see opportunities even when things are rough. In this exciting video, we're going to uncover how to turn tough times to your advantage. We've got 5 super smart strategies that will show you the way. Think of this as your personal guide to not just surviving the hard times, but coming out of them stronger and more successful than ever before. Profit from the recession by doing these 5 things. In recent times, it's hard to ignore the growing chorus of concerns regarding an impending financial crisis. This apprehension has been voiced by prominent figures in the world of finance and technology. For instance, Bill Gates, a renowned billionaire and philanthropist, has expressed his belief that a global economic slowdown is on the horizon. His apprehension may be rooted in various economic indicators and trends that have caught his attention. Meanwhile, Elon Musk, the innovative entrepreneur behind companies like Tesla and SpaceX, has taken precautionary measures by reducing the workforce at his enterprises. His rationale for this decision appears to be his anticipation of an impending recession. This move is indicative of his belief in the potential economic challenges that lie ahead. These sentiments are not isolated. They are mirrored in the broader public consciousness, with a significant 70% of Americans sharing the belief that a recession is looming. It's human nature to fear economic recessions, as they conjure images of financial hardship and instability. However, throughout history, countless individuals and businesses have not only survived, but thrived during these challenging periods. Recession is a natural and recurring phase within the economic cycle. They may appear to be catastrophic at times, but they are an integral part of how economies evolve. This cyclicality is often described as the boom and bust nature of economic growth. Before we dive deeper, make sure to hit the subscribe button and turn on your notification bell so you don't miss out on any of our updates. Let's continue. 5 steps to safeguard yourself against recession. Now, let's explore strategies for recession preparedness, ways to leverage opportunities during an impending crisis, and ensure you emerge from the next economic downturn in a stronger financial position. By following these 5 straightforward steps, you can safeguard yourself against the most adverse effects of a recession. Number 1. Build up some cash. The first crucial step in preparing for a recession is to build up a cash reserve. Having a substantial cash cushion provides you with financial security during uncertain times. Warren Buffett, the legendary investor, has long emphasized the importance of cash, especially during times of crisis. Over 6 decades, Buffett has crafted his investment strategy around the fundamental principles of risk reduction. Each investment decision he makes begins with a simple but profound question: how much can I lose? This risk-conscious mindset extends to his stewardship of Berkshire Hathaway, the conglomerate he leads. Berkshire Hathaway is structured to minimize risk for its shareholders. Buffett's affinity for cash shows his unwavering commitment to risk management. He's taken this approach to the extreme in recent decades. Berkshire Hathaway consistently maintains a substantial cash reserve, often exceeding $20 billion, to provide a buffer against potential insurance losses. Also, during bull markets when optimism prevails, Buffett strategically preserves cash, anticipating the eventual arrival of bear markets. This disciplined approach to cash management shows his belief that having ample liquidity is a cornerstone of wise financial decision-making, particularly when navigating turbulent economic waters. In Wall Street terminology, the term cash is any investment that can be swiftly and effortlessly converted into readily spendable funds. This category includes assets like your money market account held at a bank, as well as your money market mutual fund. Additionally, short-term interest-bearing investments such as treasury bills are also classified as cash equivalents. In the wake of the Federal Reserve Board's recent string of interest rate reductions, the yields on these cash investments have dwindled to levels ranging from very low to minuscule. For instance, a 3-month treasury bill now yields a meager 2.2%. Meanwhile, the average money market fund offers a slightly higher yield of 3.4%. Regardless, these yields are anticipated to decline further in the coming weeks as these funds transition from older, higher-yielding investments to newer, lower-yielding alternatives. By having cash on hand, you position yourself to navigate the challenges of a recession more effectively and capitalize on opportunities that may arise when others are financially strained. Number 2, invest in liquid business. The second crucial step in recession preparation is to invest in liquid assets or businesses. Liquidity refers to the ease with which an asset can be converted into cash without significant loss in value. During a recession, having investments that can be readily turned into cash becomes exceptionally valuable. So, invest in companies that have cash to survive the storm. Investing in liquid businesses or assets typically involves stocks or established companies. Investing in publicly traded companies with solid financials and a history of weathering economic downturns can provide you with relatively liquid assets. Blue chip stocks, for instance, are known for their stability and liquidity. Exchange-traded funds. ETFs are investment funds that hold a diversified portfolio of assets, such as stocks, bonds, or commodities. They're traded on stock exchanges like individual stocks, providing you with flexibility and liquidity. Quality bonds. While not as liquid as stocks, high-quality bonds can still be relatively easy to convert into cash, compared to other assets. Investing in bonds from stable issuers can provide a degree of liquidity in your portfolio. Real estate investment trusts. REITs invest in income-generating real estate properties and offer shares to investors. They provide exposure to real estate markets while maintaining a degree of liquidity due to their tradability on stock exchanges. Cash equivalents. As mentioned before, maintaining a portion of your investments in cash equivalents, like money market funds or short-term bonds, ensures quick access to cash when needed. Investing in liquid assets allows you to adapt to changing financial circumstances during a recession. It provides you with the flexibility to capitalize on investment opportunities that may arise while minimizing the risk associated with liquid assets that are challenging to sell quickly. Number 3, be well prepared to take advantage of recession opportunities. The third important strategy to adopt when preparing for a recession is to view it as an opportunity rather than solely as a challenge. While recessions can be tough on economies and individuals, they also create unique opportunities for those who are well prepared and strategically positioned. Take, for example, Airbnb. Founded during the 2007 to 2009 recession, Airbnb began as a way for its founders to make ends meet by renting out air mattresses in their apartments. It has since evolved into a global hospitality platform. Disney. Walt Disney started his animation studio during the Great Depression, recognizing the need for uplifting entertainment during tough times. This led to the creation of beloved characters like Mickey Mouse and a media empire that endures to this day. Uber. Launched in 2009, Uber disrupted the traditional taxi industry by providing a convenient and cost-effective transportation alternative. It capitalized on the economic challenges of the time by offering an accessible income source for drivers. Bitcoin. Created in 2008, Bitcoin emerged in the aftermath of the financial crisis as a decentralized digital currency. It aimed to provide a more secure and transparent alternative to traditional financial systems. And there are many more. Netflix, Trader Joe's, Microsoft, Sports Illustrated, MTV, GE, and the list goes on. What does this tell you? These examples show that recessions can stimulate entrepreneurship and innovation, as individuals and businesses seek to address new needs and challenges that arise during economic downturns. While recessions bring economic difficulties, they can also be fertile ground for innovation and the birth of transformative ideas. Number 4, don't cash out. Another key strategy for navigating a recession is to resist the urge to cash out hastily and instead exercise patience. During economic downturns, financial markets can experience significant volatility, causing investments to fluctuate in value. Market downturns are typically followed by recoveries, and cashing out investments prematurely can lead to missed opportunities for growth. Here are some reasons to practice patience during a recession. Market timing is difficult. Timing the market accurately, selling at the bottom, and buying back at the right moment is extremely challenging. Even experienced investors often struggle with this, and getting it wrong can lead to losses. Historical perspective. Historical data shows that markets have always recovered from downturns, often reaching new highs. By holding onto your investments, you can participate in these recoveries and potentially benefit from the subsequent gains. Long-term goals. If your investment portfolio aligns with your long-term financial goals, such as retirement or wealth accumulation, it's essential to maintain a focus on these objectives rather than reacting to short-term market turbulence. Diversification. A well-diversified portfolio that includes a mix of asset classes can help mitigate the impact of market volatility. By maintaining your diversification strategy, you can reduce risk and enhance your chances of a more stable financial outcome. Staying invested pays off. History has shown that investors who remain invested, even during turbulent times, tend to achieve better returns over the long run than those who try to time the market or frequently switch investments. While it's natural to feel apprehensive during a recession, patience and a long-term perspective are your allies. Know that financial markets have endured various crises and recessions in the past and have ultimately rebounded. Staying the course and not cashing out impulsively can help you weather the storm and work toward your financial goals. Number 5, create emergency funds. The final vital strategy for recession preparedness is to avoid taking on excessive debt. In times of economic uncertainty, maintaining a conservative approach to borrowing and debt management can safeguard your financial well-being. Create an emergency fund. This financial safety net serves as a critical buffer during challenging economic times. An emergency fund provides you with a sense of financial security. It acts as a reserve that you can tap into to cover unexpected expenses or financial setbacks, such as medical bills, car repairs, or unexpected job loss. Having readily accessible savings means you won't have to rely on credit cards or loans to handle emergencies. This reduces the risk of accumulating high-interest debt during a recession. It's advisable to have at least 3 to 6 months' worth of living expenses saved in readily accessible accounts, such as savings or money market accounts. This ensures that you have a financial safety net to rely on if your income is affected or unexpected expenses arise during a recession. While some types of debt, like a mortgage or student loans, may be considered necessary and manageable, it's crucial to approach additional debt cautiously during uncertain economic times. Prioritize financial stability, savings, and debt reduction as part of your recession preparedness plan to ensure your financial resilience in challenging circumstances. By following these 5 essential strategies, you can position yourself not just to survive, but to thrive during a recession. Don't forget that recessions, while challenging, also bring opportunities for those who are well prepared and strategic in their approach. What are your thoughts on these 5 methods? Let us know in the comments section below. And if you found this video informative and valuable, give it a thumbs up and subscribe to our channel for more insightful content. Thanks for watching.